Welcome to the Daily Brief, where I'll go over the highlights for the action in the market for Monday, October 31st. I hope everybody had a nice Halloween, and we'll see how things look for the highlights for Tuesday, November 1st. And this will be the only video posted today. I'm not going to do a full-length video. We saw pretty calm action in Monday's session, and some of that may be because of the FOMC announcement that'll be coming out on Wednesday. We might see Tuesday being kind of slow, but anything can always happen. But at least that's one of the reasons given for the slow action. Not a lot has really changed on our charts. In fact, it's kind of helped them improve a little bit, not because they moved up, we had a down day, but because they're overbought, at least in a short-term basis. But we still continue to be overbought on a short-term basis. But it helps some of our longer-term indicators show some improvement because they calculate slower and they're still going off of the more positive price action. So things are still looking fairly positive, but short-term overbought. But we've got a lot of different things going on right now. And so the market is just a little apprehensive currently. So let's go back and talk about what happened. We did have a lower open and it gapped lower right at the open to the daily pivot. And that's pretty much where we stayed for the day. We even closed just about at that level at 38.72. So prices went a little bit above, a little bit below the daily pivot. And then we closed at the daily pivot. We ended up being down 0.75%. Again, in other times, this might be seen as kind of a big move, but right now we're in an environment where anything less than a 1% move is not all that much because the markets are quite volatile with their up and down movements. However, volume was still above average. And the technicals, as I said, they're still hanging in there looking more positive. And we're still hanging out above support. We still have resistance above where we're at. So the market's just kind of trying to feel out what's going to happen from here. Inflation and interest rates, even though that's in gold here, that's a little bit less than it had been because the markets feel like they kind of understand more what's going on. After that little trial balloon was released saying that the Fed will probably raise interest rates 0.75% on Wednesday, but then in December, they might still raise rates, but less than what the market had been anticipating. So that's given the markets a little bit more certainty. And the whole way that was done, that it was through a reporter. In fact, we have another article that this reporter came out with that I'll discuss in just a moment. And it's something that they've used before, and it seems to be more valid, at least at this time. Now, that scenario can always change. Of course, we've got all the geopolitical concerns, Russia, Ukraine, things going on in China. We have the Fed, which is right now on lockdown, but there'll be a lot of Fed speak coming out on Wednesday, and then the midterm election. And again, that may not really impact the markets. It's impacting American society a lot, and there's a lot of different things going on there. And we might be seeing some kind of a shift from the current political climate over to a different political climate. So, and everybody's all speculating as to what will happen with all of that. And it might have a short-term influence on the market, but longer term, it's more what policies are they going to have? What are they going to really reinforce as far as going forward economically? What are they going to change? That could have more of a longer term impact on things. So what are some comments? And unfortunately, I've got a lot of comments here, so it's going to be a little bit smaller. And I'm kind of saying that stock price movement, it could be slowing down because of the announcement on Wednesday. And this is actually kind of positive for our technicals. We've been going up pretty strong. And even though we're still short-term overbought, it's giving our intermediate and long-term indicators a chance to kind of catch up and recalculate and, quite honestly, look a little bit more positive. And then this is another article, and I don't know how to pronounce the gentleman's name, Nick Timoreos. Okay, sue me if I'm incorrect in that, or I apologize if I said that name wrong. He came out with another article that highlighted the risk of the Fed's terminal rate ultimately being higher than the market expects. We've been going up around the 5% area, anywhere from 4.25 to 5% when rates will top out, and then they'll either stay there for a while or start to come down. And he also stated that they may stay there for quite a bit because there's a lot of excess savings, even though other reports I've seen show that people are blowing through their savings pretty quick. And then a resilience of consumer spending. Well, we have the holidays coming up, and people, even if they have to go in debt to do it, will typically go out and buy gifts and spend. So that may slow down. This isn't necessarily as optimistic as the other article that he came out with that gave the market its current scenario. There's also some worries about stagflation, not so much in the US right now. That may creep into the picture in the future, but China came out with their PMI, which was at 49.2, and their non-manufacturing PMI, which was at 48.7. When it's below 50, that means the economy is contracting, but they still have pretty high inflation in China, and they also have pretty high inflation in Europe. And the Eurozone hit a record high of 10.7 on a year-over-year basis. And that's what stagflation is, when you have no economic growth, but very high inflation. And it was prevalent more a few months ago. Folks were talking about this as it applies to the US. But this is what we had back in the 70s. If you remember that time, if you were growing up or remember what was happening, where we did have very high inflation, but really no economic growth. That's what they call stagflation. And they're concerned that that might start creeping into the picture as far as our data is saying it's. Now, there's a debate going back and forth saying that maybe we're already there, or that, yes, this is what's going to happen. But right now, that's more of a debate. We're not really seeing that because we're still seeing overall economic slowdown, but we're still seeing growth overall. And then another thing came out over the weekend where the current administration, they might really jump in and try to have a tax on energy producers because oil and gas prices have gone up so much. And that, again, that you saw this a number of years ago where they went after oil companies. They've gone after tech companies. Whoever's doing really good at any particular time, usually they get targeted for some kind of a tax. Sometimes that happens, sometimes it doesn't. But then there was another report that came out that this tax is not likely to pass Congress. So, but we're also in a different political environment right now where a lot of the things that are happening are not necessarily happening through Congress. They're happening by executive orders in the administration. And that's not just this administration. That's been going on now for quite a while. And really the last couple of decades, that's really been happening. So again, it sounds like, okay, pretty cut and dry, but we'll have to see if Congress doesn't pass something, is the administration going to go ahead and try to pass something as well? And that puts some fear into the markets. And we still have the VIX. I pointed this out for yesterday's video, that we're oversold. That means that we've been going up and the VIX has been coming down. And so we're still, with that RSI chart, we're still in extreme negative territory, which means we might be short-term topping, at least from the VIX standpoint. The S&P, though, it's still above the 50-period moving average in both of them, the exponential and simple moving average, and it's still just below the 100-day simple moving average, which is kind of interesting, right at about 3,900 currently. Now, it recalculates every day, but right now it's at the 3,900 level, and that right now anyway is acting as resistance. But so far, the support that's underneath where the S&P is at, that we broke through, that support has been holding, especially those double fib levels that I talk about in my full-length videos. Also, interest rates rose, and so that gave some headwinds to stocks actually advancing. Didn't affect them on Friday, but it did affect them on Monday. And then this whole scenario that the Fed could take a less aggressive approach in their December rate hike decision, that still continues, and that still seems to be valid. We still have all the yield curves that I follow as being inverted, with the 10 to the 5, the 10 to the 2, the 30 to the 5, and then I have the 10 to the 3 month, because that was the last holdout. And that's what a lot of economists use to determine, are we inverted or aren't we? And that one finally went inverted, and it remains inverted. Sentiment is still positive. We ticked down a little bit with the down day, but we're still leaning over into the positive or greed area, but we're not excessive currently. And we had the Chicago PMI. It came out at 45.2. They expected it to come out at 47.1, so that was lower than expected. The last time we had this report, it was at 45.7. So it's actually declined from the prior report and came in weaker than expected. Our trend is positive. The green line's still on top. We're still above 20, but it's coming down, and it's below the moving average. And I switched our bias to mixed just because Monday was kind of a blah, blah day. There wasn't a lot of conviction either way. And so we go back to Friday, which was a real positive day. So I'm keeping that at mixed to kind of a slightly negative slant because we were down. And our momentum, I'm still keeping that as positive for right now anyway. Then we have our World Series indicator. Really nothing to update here because the most recent game in Philadelphia was postponed due to rain. But right now, the series is tied at 1 game apiece. So what's our outlook for Tuesday? We're still positive overall, but short term, our indicators are still pretty far extreme positive. So suggesting that we're overbought. Now, we could still go up. Just because we become overbought doesn't mean everything's just going to turn around automatically. It just means that we've gone up or down, if they're oversold, too far too fast. And sometimes they do chop sideways for a while for the prices. Sometimes they do retreat, and that's kind of what we saw on Monday. So that actually helped the situation, at least up till this point. We also have the big announcement coming on Wednesday, November 2nd. That'll be at 2 p.m. Eastern time, and then about 2:30 p.m. Eastern time will be the press conference. We have job openings coming out, construction spending, and then the big one, and I changed the color there, is ISM manufacturing. That's probably the big report that'll be coming out in Tuesday's session. And then the whole list of geopolitical events, with really, unless one of these other ones kind of come to the forefront that have an influence on the market, it's the Fed right now. We're on Fed watch currently. But I've added stagflation to the list because you're starting to hear a little bit more about that. We have the whole midterm election, all of the different geopolitical things in Russia and China. And so any one of those could jump out. But right now, it's more watching the Fed. So our scenario's not going with the down one, even with all of these headwinds currently, because we are short-term overbought. We are going with the more positive scenario, and I say we by meaning I, because we are showing a lot of improvement with our charts. Our scenarios, the sector rotation, no, it's even when we had our up days, the rotation is, especially from the Qs, that meaning the NASDAQ 100 to the S&P, that's declining. And so that rotation area is really not improving right now. In our positive setups, some of them pulled back a little bit. Some of our longer term setups actually showed a little improvement or were unchanged. And then our technicals are overall positive because we regained some moving averages, but we still have moving averages above where we're at. We regained some fib levels. As long as those hold, that will be positive, as well as other support or resistance. And we're not necessarily going sideways. Now, the ADX is dropping. It's at 21 and change right now. If we do drop below 20, then we might go into a sideways reading for the trend. But it is positive with the green line on top. All right, so our conclusion. The S&P is positive, but short-term overbought. Monday's downward action didn't really work off any of that in the short term. We're turning more positive in the intermediate term, but a few of our indicators are overbought. Intermediate term, turning positive, but could be becoming overbought, as I said. And the long term, even though we fell back a little bit on Monday, those longer term indicators are showing some improvement, but we're still negative because we remain below the 200-day moving average. So thank you. I hope this was helpful. This is the only video that I'll be putting up for Tuesday's session. We'll see how things go after Tuesday, if I do a video for Wednesday or not.